I'm Russia Trader, and on this channel I show how Russian traders make money in the cryptocurrency market. In this video we will analyze such a phenomenon as range. It has our names: flat, consolidation, trading range, sideways trading or sideways trend. It's all the same things. The weekly Bitcoin chart clearly shows how important this topic is. The market spends most of its time in consolidation. This takes up about 80% of the entry price movement. Consolidation is always followed by a similar impulse movement when a new consolidation begins. And everything repeats itself again in bearish situation. Everything happens the same way. Consolidation starts a violent impulse. When a new sideways movement is formed, another impulse, another consolidation, and another impulse. All the same happens on any other time frame. That is why it is important to be able to identify, understand, and trade each sideways movement easily. Now we will analyze this, but first I recommend subscribe to my channel Telegram, where I show everything I talk about in the video. I work in real time. Link in the description. Be sure to subscribe. Range can be formed after both an upward and a downward impulse. Now we will analyze each option separately. There are 3 stages of range formation. Understanding them, you will be able to determine when on any market and time frame. The first stage is the formation of the swing high, from which the upward impulse and a correction begins. During the correction, local liquidity is withdrawn for sale, and this leads to the second important event, the formation of a falling extreme, which becomes potential lower boundary of the range. The local growth begins, and a new high is usually formed approximately on the middle between the first and second events, when a clear free candle swing operates in this place. This signals that the sideways trend has been formed and can already be used in trading. Now, what do you see here? After the downward impulse ends, a local minimum has formed, from which a small growth begins. During this movement, local liquidity is withdrawn for phase, and when the price forms a third swing in the region of approximately 15 of the range between the lower and upper boundaries of the range. It is important to remember that after a downward impulse, this range is formed from the bottom up, and after an upward impulse from the top down. Why is range formed, and how do different market participants act during this period? Let's compare the behavior of the smart money, of the so-called smart money and stupid money, which make up about 95% of the entry market. When the price is growing impulsively, sooner or later there comes a moment when who's willing to sell. For example, here become significantly more than who was willing to buy. This blocks the possibility of further markup of the assets by smart capital, so they are forced to rebalance the volume by forming the upper and lower boundaries of the range. They create a framework within which the price will be held, and level 0.5 becomes a benchmark, the so-called fire price. All this is done with one main goal: to attract new liquidity to the market, which will lay the foundation for the next movement. Liquidity for sale is collected below the lower boundary. Retail trade perceive this level as strong support, so when opening long position, they place stop loss beyond it. The same thing happens above, but in the opposite direction. Here a liquidity pool for purpose is formed. Traders opening short position place stop losses just above the expected resistance level, counting on it not being broken. Now put yourself in the shoes of smart money. Somewhere here you have accumulated the main volume, and the current growth extreme is only the beginning of the planned assessed markup. Consequently, reaccumulation of the position is a natural and logic step that you will take, keeping price in the sideways range to filtrate surface orders without a strong impact on the market. You need to find, or as in your case, from a zone where there will be another sellers capable of recovering your demand. Stop losses collected below the lower boundary completely solve this problem. When they are attractive, the flow of the sell orders will enter the market, which can be used to fill their farface volumes without moving the price up at their own expensive. And when the position reach boundary and the liquidity collected behind it will be used for further asset valuation. The flow of buy orders that will go to the market will not meet a comparable volume of sellers, which will immediately start an upward movement, and you, as a large capital, will reserve a profit on the position when you have accumulated here. And here smart money always tries to move the price with the hands of retail, purely information traders who do not even suspect that they are participating in someone else's larger scale strategy. Trading setup. As you already understand, smart money buys on this manipulative movement. We will strive to do the same, and now I will show you the simplest way to enter a deal. We enter immediately at this moment of manipulation. For this, a limit is set the buy order right at the beginning of the support zone. This can be a block, breaker, mitigation block, or imbalance. If there is no such zone, do not enter the deal. This is a mandatory condition, is the reason why the price should start to grow. Stop loss is placed under the order block, but if another zone of interest is used, the rules for placing a stop will be different. Adapt to a specific situation. Take profit is the upper limit of the range, but if the left side of the chart is available, when updating, the high becomes the first stake, and the first resistance zones about it becomes the seconds, where the deal will be closed. And now a real example. Considering that the price is growing, the range is determined from top to bottom. Whereas are UK boundaries, not the removal of the local liquidity pool when forming the lower limit of the range. Subsequent growth when the appearance of the swim within the specific boundaries confirm the intention of smart capital to keep the price in a narrow corridor. Under the lower limit of the range we see an unfiled imbalance. It can act as a support zone from which it will be relevant to enter a long position. The FTA first stable area level is marked above the upper border. The first problem area, which is an easily achievable target for future growth. We select a long position. We place limit orders at the beginning of the imbalance. Stop loss under the minimum of the second candle. Its breakout will cancel the setup. Take profit at the FTA level. At the same time, it is advisable to fix at least 50% of the position volume at the upper border of the range. Well, we watch development. The lower border of the range is successful update and your limit order is filed. Note that an order block has formed here. This happens with almost every deviation, and here is your deal from the newly formed order block. I will immediately clarify that you need to open either this deal or this one. You should note duplicate entries and averaging. This is simply an increase in risk for the same idea. After two candles the order block is tested and gets a strong reaction. The deal is opened. Let's see how both scanners work it out. Both the first and second traders were successful closed. In the first case, the error was 3-7, in the second 4-1. Depending on the situation, the difference may be more significant, and in this case, the choice of which entry point to use may depend on the risk-reward ratio that is obtained from the trade, which is how I make money on the cryptocurrency market, and many Russia traders do the same using this strategy. You can successfully apply it in your trading. Don't forget to subscribe to my Telegram channel, where are also my signals for trading cryptocurrency.